Okay, so balance of payments self-adjustment is widely seen as one of the advantages of a floating exchange rate regime. Another widely accepted advantage of a floating exchange rate regime is for the flexibility to have a dirty or managed float. What do we mean by that? Well, if you have a floating exchange rate regime, you've essentially not got a fixed or pegged regime. You don't have a rule book or a set of rules that you have to stick to as a government or central bank, i.e. central authority, with your exchange rate regime. So if you have a floating exchange rate, you actually have the flexibility to intervene whenever you want and not stick to a certain set of guidelines or rules as set out by the fixed regime. So a floating exchange rate is sometimes called a flexible exchange rate regime, whereby the government or central bank has that flexibility to intervene if necessary. And they would do that really only if there are temporary shocks to the exchange rate regime. So, for example, exogenous shocks, so shocks that are outside the central authority's control. And these shocks can be both upwards and downwards in the exchange rate. So let's look at a couple of theoretical examples here to get a better understanding of what we mean. So if, for example, you're an importer, so you're a country that's a net importer of goods, so you're running a deficit, a sharp increase in your exchange rate due to an exogenous shock, so a shock that's outside of your control, a sharp increase in the exchange rate can make imports cheaper. And that can cause a deficit to actually get out of control. What if you're an importer who's a net importer running a deficit and there's a sharp decrease in the exchange rate? Well, this makes imports expensive and can cause growth to slow, because you can end up in a situation where if the structure of your industry in your country imports the goods necessary as inputs to your manufacturing process, if those imports become more expensive, then this can have a negative effect on your industry, because it can decrease margins now that the import prices are more expensive. So with an importer, both an upwards movement and a downwards movement in your exchange rate can have both positive and negative impacts. As an exporter, so let's say, for example, you're a country who's a net exporter of goods and you're running a surplus, a sharp increase in the exchange rate due to some exogenous shock that's out of anybody's control, a sharp increase in the exchange rate makes your exports more expensive and can cause your surplus to go lower. And this can create a situation where you get deflation in the prices of your exported goods. Obviously, that's not good for exporters. If you're an exporter running a surplus and you get a decrease in the exchange rate, this can make exports cheaper and can cause much higher levels of growth above your production capacity as a nation. And this can cause inflation in your exported goods. And inflation can be a bad thing as well. So there could be shocks to your system created by exogenous factors if you're a floating exchange rate regime. And it all depends on the situation that you as a country are in. But essentially, because of these shocks can occur, the flexibility for central authorities, the ability for central authorities to go into the foreign exchange market whenever they want, can be advantageous, because they can readjust the currency and they don't have to adhere to a strict and stringent rulebook. So floating regimes are sometimes referred to as flexible regimes because it does give the central authorities flexibility. In cases of extreme appreciation or depreciation in the exchange rate, a government or central bank will be able to intervene and stabilize. The word stabilization is generally favored by politicians and central bankers as the rhetoric rather than the words volatility and speculation. And floating currencies in the modern world are frequently manipulated by governments and central banks. And they should really not be technically known as floating regimes. What they should really be known as are managed float or dirty float regimes. And there's an ongoing joke in the financial markets, and this is a nice example. So this sticks in your mind. There's an ongoing joke that Janet Yellen is a dirty floater. Discuss, because the Federal Reserve in the United States frequently intervene to manipulate the value of the dollar upwards and downwards. The monetary levers for intervention are basically buying and selling foreign and domestic currency, and the classic monetary levers of interest rates and money supply. The reason why this is an advantage is because these levers can be used to enable depreciation and appreciation of an exchange rate if it gets out of control. So it becomes a managed float. So out of control due to exogenous factors. So central banks and governments react accordingly to the strength or overstrength or weakness or over weakness of their currency by using these monetary levers. With a fixed exchange rate system, there's literally no flexibility to do anything. So this can be a good thing, and it can also be a bad thing. And it can be a bad thing because it just gives license to central authorities to do whatever they want, whenever they want, potentially. So it can be a good and a bad thing.